So for Singapore, the rate is DBS. So consistently, as we go through the slides, it's always going to be blue, red, blue. It's just a random. There's no particular reason. DBS has most of the earnings from Singapore. Then the second will be from Greater China. Then for Malaysia, they don't have any presence. But the other two banks has a lot. So in day to day, most of the banks tend to move more or less in line the performance, but just to give you some reflection of how to differentiate. Another way to differentiate, I mean, if this was a soccer team, you can think of DBS as probably the best team. They got good defense, good attack. Then UOB will be good midfield because everything want to balance. Then OCBC is just all goalkeeper, just goalkeeper. Then don't do anything. Don't want to pay so much dividend. Then the most important, keep my job. Then I'm not a banking analyst, so I can say what I want. So then I can, then just then just go for lunch later after that. So okay, then let's move on to the next part. Just to again dial back, how has been the performance for the banks? So the rate now, of course, DBS has been the biggest outperformer. So this is just price return before dividends. The next chart will show you the dividends. But if you look at this, then the second best has been OCBC, just purely on price. So if you look at this over the last 10 years, probably DBS is probably doubled the share price. Then UOB has been the outperformer. Hopefully nobody sees this is SG. SG means the STI. So it basically did nothing after 10 years, but no, don't look at this chart. Most important, we look at the banks for now. So Singapore hasn't really been performing. If you look at this, it's probably up 1% over 10 years. This is before dividends. Next chart. But once you add in the dividends, but of course this in theory, because this assumes how this computed assumes you collect the dividends and you reinvest. Of course, not everyone will do it, but again, this is just for computation. That the returns for DBS is probably like 3 times, and OC and UOB. Then Singapore does better then you're probably looking at average return for Singapore market with the dividends, probably about 4%. Returns a year. So DBS did very well. So if you add in the dividends, you're looking at almost a 25% return per year versus 5% for Singapore. Then how you read the numbers is 8% is for the poorest performing bank, which is UOB. But in general, the banks has performed really nicely. And of course, especially since post-pandemic, especially they've done really well, and especially when interest rates started to climb. Next slide. Okay, one chart just to get some reflection on how the performance. So in terms of directionally where banks move compared to where the interest rates move. So there is a lot of influence. Of course, you can't not day by day, like 1% move in yields, then the banks will move. But directionally, the banks tend to move along with the interest rates for obvious reasons. I mean, when high interest rates, banks benefit. So if you look at this chart, this chart, I'll just use DBS since the best performer, probably, and the most liquid, the biggest. So you can see that whenever the interest rates start to climb, banks actually start to move up, and vice versa. Of course, 2016, it probably didn't happen because 2016 was all the bank NPLs. So the banks got hit really badly 2015, 2016 because all the NPLs. Then when the pandemic happened, likewise, it came off, and likewise for interest rates, but again, it started to climb back up, and especially when interest rates start to climb. So when interest rates start to move sideways, then you should expect banks to also perform reasonably well in general, I mean, directionally at least. Next slide. Okay, so now I'm just going to look through at just the asset performance before we go to outlook, but again, just to give everyone some context. So for the Singapore banks, in general, they've grown about 5% the assets. So this includes securities and loans. So if you assume loans are slightly lower, maybe 4%. So why is this important? As the title suggests, because if you're worried about NPLs forming in the banks, you're worried. You only get worried if the assets really outperform GDP. So let's say if the economy growing 4%. So in theory, what it means that the loan demand is maybe about 4 or 5%. It should be in line with the economy. But if the assets outgrow investments like 4 or 5 times, like what you saw in the US, some of the Silicon Valley banks, where their deposits like double or triple in 2-3 years, that's where you get the stress. That's where you know that they are lending too much and so forth. So that's why, in general, this chart is important just to show you that the banks are very consistent growers. But that's meant to be. I mean, banks are supposed to be boring because you're not supposed to take too much risk. So if they grow too fast, it also means it creates higher risk of NPL. So it's like they grow steady state, about 4 or 5%. Goalkeeper, of course, only 4% and so forth. Next slide. Okay, then in terms of ROE, then ROE is one way. Okay, ROE is no, the return on assets. So why that's important is that the higher the ROE, the higher the valuations the market will price you in, because most of us will take ROE, and then from the ROE we work backwards. It's a formulate from its Gordon growth, but it's formulating. But what it means is that the higher the ROE, then we will pay more for the bank. So it's important for the bank. Of course, goalkeeper again doesn't care, but but actually one easy way to raise your ROE is also to pay more dividends. Because once you pay more dividends, your equity come down, and then you actually can improve your ROE, and you get the double benefit because everybody be happy at the AGM. And secondly, of course, more important is that the market will re-rate you better. But of course, the flip side is, you take on a bit more risk because you have no smaller equity, your leverage is a bit higher. But in general, you can see that's why DBS has perform well, is that they really outperform. You look at 2013, 2014. Of course, that's impacted a lot by their loans to the maritime or the oil and gas sector. But you can see then how they've outperformed compared to the other banks where some only play midfield, some play only goalkeeper. But at least DBS also had a better growth and ROE, and in part also because they paid higher dividends. Next slide. Okay, so the other important thing to stress again for the banks, the most important thing, the most important question to ask any bank is really how much CASA you have, especially in this environment. So if you do not know, CASA basically means current account and savings account. So right now, savings account, I think DBS mentioned they're only paying 15 basis points. I mean, nothing of it. Where they take your 15 basis points, they just park it in the Singapore Treasury, you earn 3%, and you don't have to do anything, right? Just press 2 buttons, and the guy can go take a nap or something. But so that's why CASA is so important. And the biggest strength for DBS, you can see that they have the highest CASA. Think of CASA like not so much deposits. I think it's like a loan from us, although they call it deposits, but technically all of us are just lending the bank free money. So that's why the biggest foundation for all the Singapore banks, or they call it the honeypot for them, is the free money that they get from everyone now. Of course, why people do it? Because sometimes it's salary crediting. Some companies need for working capital, but regardless, it's still a lot. So you're talking about even when the high interest rates came up, of course, CASA will come down and it will press a bit of NIM, the margins, but you can still see you're talking about 600 billion of free money for them. And you add in a 2 percentage points of interest rates on that, so you can work backwards like 1.2 billion. That's don't have to do any much. I mean, of course, there's cost. No? You need a buying branch and everything, but technically, this is where the honeypot is. Of course, it has been coming off, but even then, the banks can still maintain their NIMs, which I think we will explain later. But just wanted to emphasize this is the strength, and that's why one of the strengths for banks is mainly because they got CASA. So when interest rates rise, all this free money they can take and they can lend, but Singapore, not much places to lend. They can just park it in the treasury government bonds and earn a spread like 15 basis points. You give the government, you can make risk-free income of like 3%. But then the other thing why banks do so well is because they have a variable rate loans, which even the US banks don't, but I'll show you later. Next slide. Okay, and then we'll move on just on the share price catalyst. We are still positive on the Singapore banks. Okay, so this is our analyst forecast. So one of the things that helped the banks has been the net interest income, which is how much interest they charge all of us and how much they collect. So when interest rates rose, you can see this big jump here, like 30% growth in interest income. This is amazing compared to the pre-pandemic. Hardly grow because there's no loans growth in Singapore, probably like 3-4% long term. Yeah. But then after that, you're looking at 30% growth, then again another 20% growth purely because of high interest rates. Right now, we are looking at probably about 0.91%. Of course, DBS recent results did really well. I think they grew their net interest income high teens. But they grew because one of the peculiarities right now is that although interest rates have come down, there's this thing called they're rolling over because they still had a lot of their assets. So although DBS collect a lot of deposits, not everything when interest rate rise they will benefit all, because some of these are parked into bonds that may be like 2-year-old. Then as they expire, then they will get the benefit. So for DBS, they got like 40 billion of bonds, and then they used to only earn like 2% of interest. Then now that they roll over, they can make like another 3.5 or even 4%, if I'm not mistaken, about 4% or 2 percentage points extra. So by doing that, even though interest rate has come off, because they got this 40 billion of bonds that were the old bonds, I think of it, that were 2%. Then when it comes to this year, they can roll over and earn another 2% by doing nothing. Just roll over, no, 2 phone call. Yeah, I want to roll over. Then they can earn an additional 2 percentage points on 40 billion. So like, okay, I'm a math. So about 800 million plus just doing, again, not say doing nothing, but just to roll over. So that's why even though interest rates come down, you will still see them holding their net interest income reasonably well for this year. Of course, there are some headwinds too. You lose CASA, but in general, this year will still be fine. And with interest rates still holding high, then of course the interest income will continue to be even better than expected. So there'll be one trigger. There's upside surprise because the interest rates not expected to cut. Base case now is probably like one cut. You can't do any cut in because interest. Okay, so anyway, in terms of where the Federal Reserve cut now, the general case is that June, no, because the inflation is too high. July, no. September, too close to election because the Republican parties will be selecting candidates. November, of course, cannot cannot because of election. So the most likely time the Fed is probably going to cut rates probably only December. So throughout that time, you're thinking of the interest rates will still going to be high. Next slide. So the other thing is the loans growth. Loans growth, again, it's picking up, but at most you're probably about 2-3%. So what is helping loans growth for Singapore banks now is actually inflation benefits them actually, because when there's inflation, commodity price rise, then companies need to borrow more because everything working capital needs rise. And also the other trigger is that inflation, of course, also helps in raising interest rates. So that's why inflation is a beneficiary. So when investors want to hedge out inflation, our Singapore banks, especially because we have floating rate loans, is one way to hedge out inflation because number one, the demand will rise for loans, but that's a smaller thing. The main thing is that high interest rates, the banks will benefit, like we showed you just now. In terms of expectations, it's not going to be fantastic, but last year there was no loans growth. So this year, looking at 2-3%, which is going to be good. It's still going to, so it will help also offset the weaker net interest income. So you're looking at probably a low single-digit loans growth, and most of the growth is also going to be coming off from overseas, from like India and so forth, for like company like DBS, because mortgages, demand for mortgages also is pretty soft right now. And in Hong Kong, if you have Hong Kong right now, you're probably going to face negative loans because most of the Hong Kong corporates rather go to China cheaper. It's only a stone's throw away. I'm not just kidding. But they just go to Shenzhen and they can borrow so much cheaper. So loans growth is also taking a hit. So those banks, banks with Hong Kong exposure will face weaker loans growth. Again, this is going to too much details. If you want to know, next slide. Okay, but so this is going to be the main growth driver for the banks. I think DBS fee income, at least the wealth management income, grew about 40%, but because there was Citibank Taiwan, you take that out, they're still growing at 30%. So this will be the main growth driver. This fee income is good because one of the main reasons is because you don't need capital, right? You don't have to lend anything. It's just fee. Just your private banker call you and then you sell some products. So basically, we think this will still be the main growth driver for the banks, which is fee income, and it will depend on the environment. So this is a stabilizer in a way for the banks. So if you assume interest rates come down, then of course the equity market would be more buoyant. Then this benefits their fee income because a lot of our customers, most wealth management customers are holding deposits. Since you got earn 3-4%, why not? But if the equity markets improve, then you will see the fee income grow because a lot of the customers will start to buy investment products, rightly or wrongly, but that's the phenomena. So that's why the fee income. So even though if interest rates come down, there are a few buffers for the banks, namely because fee income will grow because investment products. So their wealth management income grew really strong. They're talking about 30%, which is phenomenal. Next slide. And the other thing is that the structural thing that's benefiting Sorry. Okay, the structural thing that's benefiting all the Singapore banks is this thing, is asset under management. One thing we know, if you go to wealth management, we will stand out compared to our Southeast Asian peers. I mean, some of them wealth management might still be selling insurance, but at least for us, for DBS, they can still sell structured products. They can create structured products and so forth. So that's the strength. And of course, we continue to grow the assets under management. So this is one of the structural benefits for Singapore banks, because they're growing probably like 13% CAGR over the last 5 years, and it continues to accumulate. Of course, the numbers are affected. No, market good, of course, the EM also go up, but they're still getting net inflows of probably like 5 billion or 6 billion a quarter for some of the banks. Next slide. Okay, so this one was just a quick look at the fourth quarter. We don't have first quarter, we didn't have DBS, so I didn't. But the key message here is just that no fee income will be the main growth. And for the PATMI this year, I think just expect banks to grow probably high single digit at best. The one that you saw in DBS, the jump was a bit abnormal because there was a bit of the acquisition. Citibank earnings came in. And also the fee income was a bit abnormal. So you just assume like a high single digit growth for the banks. Next slide. Okay, then the one very important driver for the banks is of course dividends. Also, okay, for anyway, just to a lot of people ask us what CET1. So CET1 is basically CET1 is just the high quality capital, the most permanent. That means the one that won't disappear, which is basically your retained profits. I mean, it's just another, in a layman terms, very fancy word, but because sometimes the banks borrow certain type of instruments that can look like an equity, but this one CET1 basically means that equity largely retain earnings and share capital, and basically is the one that is permanent, it doesn't go. So why this is important? So most of the banks use this to determine how much dividends they want to pay. So of course, Goalkeeper, I'm not sure why they're still hoarding so much, and DBS is also highest. Of course, you'll be a bit more conservative because they stick to their payout ratio 50, but hidden in this 14.7 now or whatsoever, there's also the new Basel IV rules, which actually all the banks can release. So once the Basel rules come out, their capital here will gap up probably another 100, maybe another 150 basis points. So this red line could jump to 16%, 17%, which of course is a bit too high. And just to give you how much money they can actually pay out. So DBS pays out dividends roughly 6 billion. But when they just jumps up, this could be another 6 billion of capital that available for them to pay. So they got a lot of capacity to grow the dividends. It's just how much they want. Of course, this one will just go up to rescale the whole chart. I don't know where it's going. But anyway, he doesn't want to pay. But to me, this is the upside. So if the first half, they actually did say that they might raise their payout ratio. So because it's a bit atrocious, I mean, you got like keep out so much for, I mean, you want to keep your job, safeguard your job is one thing, but I mean, you have to give back some to the shareholders too, right? So that's why we think DBS has hidden capital, because this thing will gap up, and they also have another 2 billion of provisions. So a lot of these banks can over provide. So they got another 2 billion of provision because they think our market economy might be a bit bad. Although there's not much bad loans, but I never mind. I just put 2 billion in the Kitty Bank. So that's why there's a lot of capital. So don't be surprised if even the earnings fat, they can still grow dividends, because there's another 6 billion available and they pay 6 billion a year. So of course, they're not going to give you all special dividends. Is a silly idea. You give 50 cents, then your share price drop 50 cents, then I don't know what happened. So that's why they won't pay special. They probably use it to top up. So you could actually even assume that they can keep a 6% yield, because they can always just raise the dividends, because there's a lot of capacity. You'll be a bit conservative. Okay, then let's move on, and we don't have a buy call on them. Okay, so on our stock picks. So next slide. Okay, so this is again, this is just a reflection on why DBS did well. It's not because they were better in doing IR and so forth, but they really performed really well. You can see the earnings, net profit, they jumped to 10 billion. So why they paid more? They used to pay, let's say they make 10 billion, they used to pay 50%, but then they pushed it to 60. That's why they gave like 6% yield now. This one all still stay 50. So OCBC say they might pay a bit more, then UOB just stick to 50. But that's why DBS is the outstanding, the outperformer. Okay, next slide. So in terms of a view, this was the same slide I showed in because I'm not the okay, but okay, probably it's now 6.1. But one of the reasons we like DBS is mainly because of the yield. So 6% yield, and the earnings can still grow. And the upside surprise now with the high interest rates and the momentum in fee income, we think they could beat our expectations. So let's look at them. Probably they can look at probably a bit of a high, low teen style growth for them this year. Next slide. I'm going to rush this. Okay. So last slide for me. For the other two banks, we still have a buy. We just like it because it has the highest capital, and there's upside surprise. So they cannot keep this capital for too long. You just too much already. You're holding it too much. A lot of shareholders will start to riot outside. But anyway, but the valuation is also attractive compared to other bank, and they said it's minimum. So they did hint that they're going to pay more, because they no longer said their payout is 50%. They said minimum at 50%. So they're just hinting. I think one of the reasons might be they might be looking for some acquisitions, but they did. But if they're not doing any major, then they should pay. So to me, this is a bit of a dark horse that they might pay out. Then after they announce, then just run away, because after they're just going to become goalkeeper again. Then the next thing is UOB. UOB a bit is the highest growth from our forecast, but again, it's neither, I would say neither here nor there. I mean, but it's just in the middle. So nothing. So in terms of relative, we still prefer DBS compared to UOB. Stable NIMs, and of course, if you're not comfortable with China, then people will go to UOB. So sometimes some years UOB will outperform because people are a bit more hesitant, careful about China. Then they will go to UOB for relative performance because they don't have, and they have Malaysia and so forth. Okay, I think that's it for me. It's not easy to talk 25 minutes on banks because nothing happening, right? So anyway, do join our community. This is where you come in and you can just ask questions, and hopefully you ask the analysts or not. So because they will have to answer you. So this is where you join our community with a Singapore analyst. Then you keep questions, technical ones also our analysts. Then you will try to help address as much as we can. Okay, I think okay. Thank you everyone for your time.
All right, thank you, Paul. So I'll give this slide a bit more time for everyone to scan if you wish. You can join in the P3 community for research team's special dedicated channel. So in the channel, right, they will actually reply, the analysts will reply to your questions that you have. Of course, it might not be immediate, right, but they do reply for your question as well. Okay. Right, so I will be discussing mainly on the Hong Kong side, right? Some of the recent market trend as well as some of the developments for the Hong Kong, the China tech giants. All right, so disclaimer, so it's not going to be any recommendation in the discussion. So any stock that I do mention will be mainly for education purpose. All right. Okay, so basically, this is a recap, is that Hong Kong actually started the year 2024 at a lower side, right? January started off on a lower end, right? As it continued to fall until 14,800 in January. So it's only 200 points away from the low of the 2022 October of 14,600. All right, so of course, right now, I think you're aware, if you follow yesterday, the last week itself, the full week has been quite a good week for Hong Kong. You have recovered quite well, above 18K now, I think around 18K 500 or so. Right, so right now, another thing is that the China government also launched various policies which actually want to stimulate the stock market, and some of which have actually seen some effect, I believe. So that's why you can see the end of April to May, the performance is a bit better. So some of the policies is I indicated here as well. So first one is that they actually enabled some of the stock, the central funds, some of the funds to actually allow them to buy the China's ETF directly. So the equity stocks instead of only bonds. Then the PBOC also reduced their RRR ratio, which is the reserve requirement ratio for the banks and the financial institutions, by 0.5%. And also they did not push ahead with some of the draft regulation policies, which was the main reason for the fall earlier in the year, right? Or end of last year, actually. End of last year to start of this year. So the main reason for the fall was actually some of the draft regulations that Hong Kong side or China side tried to implement. Okay, so for the first Q, right, first quarter, summary is Hong Kong Hang Seng Index fell by 3%, and Hang Seng Tech Index fell by 7.6%. That's the current first quarter ending. Of course, now we're in May. Okay, so we do have certain contexts that need to be worried about. So one of them, just move this away. This thing blocking. Okay, never mind. So these are geopolitical tensions, basically, right? So first one, we do have the Russia-Ukraine war that is still increasingly tense in impact. All right, so it has been dragging on, But the main impact is actually not on the direct impact onto oil, but more onto the geopolitical situations between Russia and Europe, all right, which also will impact how US try to intervene that segment as well. All right, so we also have the Israeli-Palestinian war, which also impacting the Middle East economies, especially some of the different developments that you can see recently through the Israel, Palestine, Iran, and everything. So all these contexts will continue to play a part for second half of this year, especially for May and June. Second half of this year, especially we expect that there might be more activity going into the US elections, right? Because some of these Middle East countries, some of the entities will try to play a bigger part. And US government so-called will be a bit more vulnerable to their reaction because it will impact their re-election chance. Right. So how the US government react to this so-called Middle East issues, right, will actually impact their elections chances as well at the end of the year. Okay, so next one, we do have the currency pressure. So the US Federal Reserve, of course, start of this year until now, it has been moving quite a lot in terms of expectations. Expectation meaning that the actual realistic goal might not be there. So it actually expected 75 basis point cut by end of 2024. But I think as you heard what Paul mentioned just now, most of us now have moved to the expectation of only one cut by end of this year. And this move was just purely from between February to now, which is quite a short 3 months. So, and the difference is a 50 basis point, which is two cuts, right? So it means that most of the analysts now only expect at most one cut end of year. Of course, at most means that some of them still expect more than one, but that's a minority now. Compared to previously, which was three cuts, which was a majority. Okay, so the persistent inflation did reduce expectations for cuts in the inflation. I mean, in terms of the rate cut from Fed. And actually, at one point, I think if you got follow the news, at one point in April, they actually wanted to say that there was likelihood no cuts in the US because of the persistent inflation due to the recent numbers of inflation numbers. But thankfully, which is also quite lucky, is yesterday news. So today is Saturday, right? Yesterday, Friday itself, US did release the job data, which did indicate that there is a bit weaker job growth, right? So for job growth, right, it actually helps, this weaker job growth help to increase confidence that Fed will cut rates. Why? Because for Federal Reserve, there's two main goals, not only for inflation to go to 2%, but also to keep unemployment low. So technically, even though the inflation part might not be hit, if they actually do cut rates, because it will actually boost, it also got increased inflation. But by releasing rate cuts, it might help to stabilize the job growth sector. So that might give the Fed some incentive to start the rate cut. So that's why now I think we see yesterday news of developments will be for the upcoming week as well. The probability or the expectations of rate cut will start to increase for at least one. That's my expectation as well. Right. So also next thing is the slow progress of rate cut coupled with the US, coupled with the China's rate cuts of their own, equals to China currency weakening. Right. Basically, if your currency is going to cut rates, while the other currency, which your competitor is increasing rate or maintaining their rates, then your currency will weaken. Okay, this is how currency exchange, the movement works. Because very simple reason, if US giving higher rates than China now, people will move their funds from China to US to park because they get higher interest rates, right? But by parking the funds. So this is one of the main idea for the currency impact. So that will also impact how the stock market will move eventually because it's a implied pressure onto the renminbi denominated assets. Because when you put money into the country, right, you have to invest into something there. But then the good thing is that for their, let me see, I can move this away. Okay, I'll push it down anyway. So the US-China tension is still ongoing, right? So the China economy being so weak for a period of time, I think from last year until now, they actually now have weakened their stance a bit, right? They try to attract more foreign investments. So you see more actions by the China government to try to attract the foreign investments. And they actually made a lot of different visits, right? Even Xi Jinping president have made visits to the US to try to meet the various business leaders to actually come with some agreements as well. Okay, next thing is also that this year's US elections will definitely impact US-China relationships because you know how Republicans and Democrats have very different stance towards China. So if let's say the Republicans do win and let's say Trump do actually suddenly get elected again, you can expect very volatile relationships between China and US. Of course, we hope a bit more stability lah, in terms of us being a third party, right? So we also want to have a more stable results from, but we cannot expect or cannot determine right now, right? So next thing also, the US efforts to slow down China, the tech development is also ongoing on a very strong basis. You can see a lot of news regarding how they want to impose on ASML not to sell certain equipment to China, and how China released news that they actually managed to do some breakthrough technology of the semiconductor, even without those technology. So these are just news of power play, mainly on a tech war. So it's a bit similar to how US and China, US and Russia actually had the space war or nuclear war in the past during the Cold War era. Right now, China and US mainly have this competition through the tech side, which is the new so-called the new competing path, right? Mainly for the AI segment. Okay, so the tailwinds basically, even though I mentioned some of the headwinds or some of the things that risk factors for China, there's a lot of tailwinds for China. First one is that deflation concerns are starting to ease. So deflation concerns is when actually there's less buying demand and then supply is oversupply, right, in China, where those people are expected to see different issues based on the property segment, based on the different cost of living of certain cities, so-called. So there were some deflationary concerns, except for food, of course, but the rest of the sectors have some deflationary concerns. But right now, they come to ease due to the China's intervention of government. And regulatory risk also try to reduce with draft measures not implemented. So give more confidence for investors that China government will be actually more prudent or more conservative in how they advance. Also because right now the economy not doing that well. So likelihood, China government will only implement more drastic measures or more aggressive measures for controlling of the economy after the economy stabilizes. Right. So right now it's mainly on the rescue package side. So the China side actually launched a few rescue packages. Just right, you can see over here. First one is they have more room for rate cuts, right, as well as interest rate cut directly, other than only triple R. They also have issued special government bonds, right, to promote economic growth per se. And also they allow some of the city governments, some of the various cities which have property projects that are slowing down or being in limbo, they allow them to recommend certain projects to actually to the banks for lending or funding. So it helps these companies complete the project, so-called, right? So they complete their requirement. All right. So next, the net inflow of the foreign capital, which I'll mention later as well. So deflationary concern easing, right? First one, you can see the China manufacturing PMI is currently at 1.7% month on month, right, for the March. So this is finally back to above 50. They were sub 50 for a while, right? So they actually have some concerns on that segment. The non-manufacturing PMI also increased to 53. All right, so it's also a 9-month high currently. So it's also indicative of a stronger economic growth in China. So also leads towards the fact that China might manage to hit their GDP target for the year of 2024. Okay, so of course, one thing to note is that the retail sales of consumer goods have not really met expectations of 5.5% versus the expectation of 5.6%. So this basically means the actual sales of consumer goods, right, consumer level goods, is slowing down in China, all right, or maybe there's some static growth inside there. 5.5% is quite good, right? Just that it's lower than expectations. And the thing is that you can see higher growth mainly on the aspect of fixed assets, where China is trying to improve a lot on their infrastructure to actually improve the country's growth per se, or long term. Okay, so for the stock market rescue package, which will impact us a bit more if you're trading into investing into the China Hong Kong market. All right, so PBOC have cut the interest rate by 1.5% since 2022, and they have more room to cut because currently the rate is at 7%. Right, so it's quite a bit of room lah. I expect that even until 5% is still quite safe for them. So they do have room. Just not that they will cut, but there's room for them to cut if they wish to. And also, they also cut their prime loan rate by 0.7% since 2022. And the current rate of 3.95% is also still quite high. Right? If you compare to when US tried to cut rates to boost the economy, US cut all the way to zero. Of course, China unlikely to hit to zero, but from 3.95, you can see quite a long way to go to even 2% or 2.5%. So they do have a bit of ammunition on hand that the PBOC can do to actually boost the market. And some of the people say, hey, China can do the quantitative easing similar to how US did it. So the US did QE because US have already cut rate to zero. There's no more MO already. MO zero. So they come up with this new thing called QE. I boost more bullet come out. I say I pump money into the market. So that's the US method. So China does not really need to do it unless they have no more MO, right? So if they have depleted the first two, which is mentioned, then they might consider going to the QE. But of course, right now there's no real need. There's still rate cuts going on. There's still rate cuts ammunition going on that they have on hand. Okay, so another thing is that they also are not able to directly buy treasury bonds in the primary market. They can only try to trade it or buy on the secondary market. So if they do change the law, then you might expect certain differences on how aggressive they are to boost the market. So right now, China is not yet in the full-on mode to try to boost the market. They want to do it on a more stable basis. They want to do it on a more long-lasting or more sustainable mode. Okay. Okay, so of course, there's also net inflows of foreign capital. You can see that this IIF, right, they expect that there's a net foreign capital into the emerging markets, which include China, of course, for 4 consecutive months in February. And the inflow into China stocks reached 9.6 billion, right? Whereas outflow from the China bond market is 6.5 billion. Right, so of course, I think you can know why there's outflow of China bond market. There's a few China bonds or some China issuance of bonds that have starting to default on their payments. So there's some risk concerns over there. There's some factors where certain investors are not so comfortable with China bonds, so they might start to release of China bonds. But because of the current environment, the China stocks itself became a bit more attractive in valuation, and thus there's a lot more investment through the first quarter, even until April. Right, so we expect this to continue, and that China inflow might still come in to the China stocks itself. So there's a net inflow of foreign capital. All right. Then next, you also see that the global market is still underweighting on the China stock market as a whole. Right? Of course, in April, the whole April actually recovered very well already. But as a whole, in terms of relative basis to the US market, China is still very undervalued compared to the US and Europe. Even compared to Japan, if you wish to see that. So, okay. So for the China tech giants, right, I wanted to just share some of the vulnerable sectors that you might see in China. So first one is that the China computers itself, the chips, biotechnology, and AI, these are sectors that are so-called on a more vulnerable basis, purely because they are on a target list of US. So meaning that US might directly sanction or impose certain regulations onto these sectors, which might impact the growth of these sectors, companies in China. Right, so you can see the US already introduced certain bills, and the most high-profile case that I think you're all aware of will be on the US bill on the TikTok, which is the ByteDance on the subsidiaries. All right, so technically, US would want to slow down the growth of China in tech, all right, and a lot of companies that have a high proportion of business in US or they are highly related to US, they might be actually in more risk. Of course, these vulnerabilities mean that they have a higher risk on the geopolitical side, on the more regulatory side, but that doesn't mean that they have no growth internally. Internally, the company might have very strong growth basis on when they release results and everything. Okay, so there's also restrictions of the flow of most of the high-end Western technology to these chips. So of course, these companies might have to do their own R&D. They cannot rely on the purchase of the chips as much as previously. Okay, so whereas we are bullish on this sector is that sectors that have very high consumer demand on the domestic side and consumption attributes, right? Because there's less deflationary risk, there's inflation. There's also going to be a bit more of an internal demand by China, right? So Chinese government will first stimulate the economy. Second is that consumer sentiment are increasing. Third one is that consumption attributes and domestic demands also means that they are more resilient they are not as vulnerable to the US actions itself. Okay, so some of the examples that I mentioned here is the e-commerce platforms, your sporting brands, your branded, your retail chains, your food brands, right? Even bubble tea stores, right? And then fashion brand as well as the tourism and hospitalities. Okay, so one of them that I will mention in detail, which is going to be JD.com. So 9618. Okay, so basically it's previously famous mainly for e-commerce platform selling on tech goods, right? Selling your computer, selling your mobile phone, and everything. So they have already evolved from e-commerce into a service provider as well. So first one is a JD Retail, which is your more familiar one. They do the online diversified shopping platform. Not only online, but also now they have a retail infrastructure. They have more than 10,000 points of retail, the physical outlets for them to actually deliver or sell their goods. Then there's JD Technology, which is more for the digital intelligence side. And this is the segment that's a bit similar to how you can see is a cloud computing, the AI, generative AI and all that. So they're investing into this part, the big data, IoT. So this company is no longer just purely e-commerce. And some of the US, I mean, some of the China tech giants are similar to US. They will start to divest away from purely only one subsector. They will invest into other subsectors into the tech scene as well. So you can take a look. So right now I'm just sharing more on for JD lah, right? So JD also have some exposure into the JD Health, which is the health segment, which actually grew quite a lot during the COVID period, where there's an increase in the tele-doctor type of services and demand. Of course, right now there's a different type of demand just due to the convenience sake of it. It's no longer due to the COVID or the pandemic issue, but this particular segment can still actually grow based on the distance or the size of China, right? So sometimes people don't have the availability of the medical expertise in certain rural areas, certain hard to reach areas. So they have this, all these type of services. It's not the only one. It's that JD Health is one of the different companies that provide this service for China. And also JD Logistics, I think you might be aware, right? So e-commerce usually have certain partners that they have for logistics side. Either they invest on their own or they have a very good partner, strategic partner for it. So for JD, one of their advantages is that they have a very strong logistics arm, right, since the past, right? So this is the site that actually helped them to move on the 6 different industries. So no longer just purely for the 3C or technology side, the computer side. They also now do FMCG, which is the fast-moving consumer goods, your shampoo, food, everything, clothing, home appliances, and as well as automobiles even. Okay, so this basically, okay, can't really see the top, but basically the bullish sector, the result is that for, this is shared by our Hong Kong analyst, Louis as well. This is a slide that I actually took from him. So basically, what I'm trying to show is that the JD results, right, has been showing a growth across the different revenue, operating profit, and everything, even the operating profit margin. And they do give dividend, even though it's very low. Okay, of course, high dividend might not be good because US listing might not be, there's this thing called a withholding tax. So too high not good as well anyway. But right now, by giving dividend, it's trying to show the confidence that they have of their cash flow for JD.com. And the one that will impact you more will be that this company also have a share buyback program, which usually this helps to boost the share price more when, especially when the stock might be underpriced. You might see the company come in to actually do the share buyback to boost the share price as well. Okay, so this is the chart you can see for JD.com. So this is the 52-week high and low on the right-hand side over here. So 161 is this is the chart is from February to now, February to as of yesterday, right? So as of Friday, close of market. So February to I think 3rd of May, sorry, right? So high 161, 78, and 126 the current. So you can see the current price is around mid-range of the year. And right now we are looking that this year the JD.com is one of the companies which is on all the segments that I mentioned about resilient to US market. They are e-commerce, but even though they're listed in US, but they are mainly on domestic demand. And they are doing logistics, which is also consumer trends, right? So they have very strong growth potential for this year. You can take a look on the sector. The other tech giant that actually I shortlisted to take a look at is for comparison's sake is the Alibaba. So if you see the high and low, right now the current price is also around midway. Of course, this counter have been very punished over the last year until even this year. All right. So you can see actually this year itself, in April, they reached a low of 65.8, right, which is actually broke below the 70 support for surprisingly quite a fair amount. All right. But actually, when this happened, actually, if you see the news, Jack Ma suddenly appear. It's like savior, you know. Suddenly someone just give some speech, suddenly the stock gold price go up. Yeah, but basically this what happened. Jack Ma appeared and the stock price just boost already. But anyway, the idea is that Alibaba is still a very strong company as a base. Right. The issue is that they have not yet found a new footing to stabilize in the new economy because they have a very strong competition in the environment in China. And there's a different type of new issues that they are facing. But previously, one thing to good about Alibaba is that one of the item I mentioned just now is that regulatory risk is easing off. So one of the main thing that impacted Alibaba's share price was the regulations, right? Especially on the Ant Financial, on all the different subsectors that they have. If the China government relent or like release more pressure onto this regulatory side, Alibaba do have certain growth potential as well. But of course, this is going to be a volatile stock, which will be relevant to the next topic later, where how you trade on volatile counters itself, when you do both long and short strategies. Okay, next we do have Tencent. Tencent is the 52-week high is 364.4. The current price is 363.6. Okay, so you can see this is a stock that is very near the 1 year high, and actually the trading of yesterday itself broke that 1 year high, right? The trading itself, of course, the closing didn't, but the trading itself hit 372.6 for yesterday. So Tencent is a counter that have very much recovered, right? They have very strong growth, right? They have managed to recover the revenue because of the release of the gaming titles. They can actually now release more game and everything. So previously, they are impacted mainly on this segment. All the revenue, main revenue source is on the gaming side, where they actually face regulations stopping them from releasing new titles for a very long period of time in 2023. So Tencent is a company that can do very well, but it's already at 1 year high. So some people are already worried that, will there be a retracement, right? So you might be interested in seeing how you can actually either do a long position or hedge your positions or even short the position if you wish to short the counter. Okay, so Meituan itself, another one. All right, Meituan 159, 61.1, 119.2. Currently also mid-range. But Meituan is also the counter that fits into the sector that I mentioned. So they are a counter that do a platform, the counter that fit into consumer preferences and demands, right? Because people are used to food delivery in China, right? Singapore, we cannot use that. Okay, we buy one cup of bubble tea, 1 cup of coffee, we need to pay $5 of service fee, platform fee $4, then the cup coffee cost $10 from kopitiam. Then don't make sense to us. But for China, they can order one drink, one bowl of rice is affordable to them because the minimum cost of delivery is very low. And Meituan is one of the companies that help to boost that type of demand, so-called. And when everyone is on the platform, they have more pricing power with the vendors. That's why they can earn their profit. Right. So one side news that they have is that previously people thought that Meituan will come Singapore. So they almost want to say, hey, maybe Meituan want to buy Foodpanda, but never buy lah. So Meituan not in Singapore yet. But idea is that they are very large in terms of the expansion. So they expanded into other countries outside of China as well. But it's all on food delivery side type of a segment. So even though they are not purely on domestic China itself now, as they expanded out, but they are still mainly on consumer preferences and styles, right? And they are still a platform company. So company to also take a look at as a big company per se. Okay, so next I will pass the time to Marcus, who will share more on this asset called the DLC, right? So the leverage certificate. You can then now learn how you can actually potentially long and short the counters, right? Yeah. Without further ado.
Okay, hi everyone. Thank you for coming down today. I know it's a rainy weather, but thank you for taking the time to come down on early Saturday morning. And I hope you find the talk from from Paul and from Huan Zi, very insightful on the on the Singapore banks as well as the Hong Kong stocks. So now you probably have a bit of a direction, right? Okay, bullish or bearish short term or long term. Well, then thereafter comes how do you express your view, right? So today, I've been thankful for Philip for giving me a slot to share with you guys a bit about this instrument that is listed on the SGX securities market. All right, these daily leverage certificates. I hope that you guys have heard of it because we've been around for 7 years on SGX already. If you haven't heard of it, hopefully then today you'll get a good idea of what this can do for you. Okay. All right. So the daily leverage certificate stands for daily. It's also DLCs. Okay. All right. So these are all listed on SGX securities market. It's issued by Société Générale. So Société Générale, we are the issuer of these DLCs. We are a French bank. We are known for doing structured products. All right. So we don't have a retail presence in Singapore. We're not like a DBS or UOB, but we are like a DBS or UOB in France. All right. So, but we are known to do structured products where we have over 50,000, 100,000 products listed on the European exchanges. And we brought this over to Singapore back in 2017, and it's been growing year on year and has surpassed that of your local warrants market already. Okay, let's go to the next slide. Next slide. So today, I'm just going to give you, next slide, a bit of an introduction of what the DLCs can do and show you some practical steps on how to get started on the DLCs. Okay, so this is a fixed leverage product. Okay, so for those of you who are very familiar with your TQQQ or your SQQQ in the US, the ProShares Ultra, NASDAQ, long and short, inverse leverage and inverse ETF, these DLCs give you the exact same payoff. All right, gives you the same exact fixed leverage payoff of 2 times, 5 times, or 7 times of the underlying stock or underlying index daily percentage performance. All right, just that these daily leverage certificates are in a certificate structure, which means we can go higher leverage than your leverage and inverse ETFs. So if you see your leverage and inverse ETFs out there, it's always about 2 times or 3 times leverage that's capped. But over here, we can go up to 5 times or 7 times leverage. All right. So if you think of this kind of leverage level, this is a short-term trading instrument, a tactical instrument that you can use as part of your portfolio. All right. But it's not a buy and hold instrument. All right. So this one is all linked to an underlying asset, either underlying stock or underlying index. And today we talk about Singapore banks, we've talked about Hong Kong stocks. Well, these DLCs do track those underlying stocks or underlying index as well. Okay, it's all traded on the SGX, very much like a stock. So you can trade it on your POEMS 3 account. You can trade on your POEMS the same way that you trade your DBS shares or UOB shares. You can find the DLCs on your POEMS account. You don't need to open a separate account. Okay, so this is like a regular stock. You trade it the same way that you trade a regular stock on the SGX market, but this is a leverage instrument. All right, we are the issuer, Société Générale, SocGen, and we are also the designated market maker. So we provide liquidity for these DLCs throughout the trading day from 9 a.m. to 5 p.m. as long as the underlying asset is moving. So Singapore stocks 9 a.m. to 5 p.m. we provide liquidity there, bid and ask prices. For Hong Kong stocks 9:30 a.m. to 4 p.m. All right, so that is where we'll provide liquidity. So if you get in, you buy a position, you don't be afraid you won't be able to get out because we are always there to provide that kind of buy and sell prices and volumes for you to get out as long as the underlying asset is moving. And this is regulated and obligated by the exchange. They are monitoring us every day for this. Okay, so this one, you be assured that there is liquidity for you to get in and out. Okay, that's the number one concern that people usually have for this kind of product. They say that, I see that there's no turnover on this DLC, but we have over 200 DLCs listed on the SGX. Not all of them are traded every day. Some days people like to trade Kuaishou, some people don't like to trade OCBC stock DLC on certain days. And so OCBC DLC, there's no turnover on that, but it doesn't mean that there's no liquidity because we are still providing bid and ask prices and bid and ask volumes, at least 200k Sing dollars to 500k Sing dollars on each side for you to buy and sell the DLC, even though there's no trades for that day for OCBC, for example. All right, so that is a common misconception. All right, and the daily over there is another misconception where people say, oh, so I can only hold it for intraday only. Yes, you can trade this intraday. It's a very common strategy that people use to trade the DLCs because 5 times leverage, 7 times leverage intraday, I can make 15 to 20% gain easily. Right, so there's a lot of intraday traders, but it doesn't mean that you can't hold it for more than a day. All right, the daily stands for the fixed leverage because that fixed leverage is a daily reset. Every day you get the same 5 times to 7 times leverage. All right, next slide. So we have a wide range of underlying assets available for you to choose from. We started off with just 10 DLCs on indices back in 2017, but we have expanded it to now over 200 DLCs, all right, covering Hong Kong, Singapore, and a bit of the US market, all right? So Hong Kong market, your Hang Seng Index, Hang Seng Tech Index, Hang Seng China Enterprises Index, we definitely cover them. Hang Seng, they're actually our most actively traded DLCs, the Hong Kong market shelf, because I'll touch on that later on. A lot of people see the value proposition of using the DLCs as an instrument to access the Hong Kong market. Okay, you can trade it in Singapore, you can trade it in Singapore dollars, but you can't get exposure to Hong Kong stocks. You don't need to go and change your money to Hong Kong dollars. You don't need to worry about the Hong Kong exchange stamp duty or kind of like a microstructure of the Hong Kong exchange, but you trade it within the comfort of Singapore. So that's our most popular shelf, the Hong Kong one. We have the three indices. We have also all the China tech giants, which I want to talk about. Tencent, Alibaba, Meituan, JD, you name it, we have it. 5 times leverage, long and short direction. All right. And the Singapore market, we have the indices, STI index, your MSCI Singapore index, as well as your main Singapore stocks, your banks, Singapore banks, as well as your Keppel Corp, Sembcorp, all this. Okay. So we do have a wide range of Singapore and Hong Kong underlying assets that you can get exposure to using our 5 times, 7 times long and short DLC. All right. So the US indices, we just started this shelf, trying to expand as we go along. But right now we have the TQQQ and the SQQQ. I mean, we have DLCs that are similar to that, but we go up to 7 times leverage, the S&P 500 index, the NASDAQ 100 index, and the Dow Jones index. Okay, this one's quite special. This one you can trade 5 times, 7 times leverage, long and short direction, and you can trade it during Asian hours. So this one I'll touch on in the next slide. So the US indices DLCs are something that is unique and it's quite a value proposition for those who are interested in the US market. We give you 5 times, 7 times leverage, both long and short direction on the US indices. This is higher compared to your TQQQ or the SQQQ or the SPXU or your UDOW in the US, where only kept at 3 times leverage. Here you get 5 times, 7 times leverage, long and short direction. Okay, so this one is the catch is that you can trade it only during Asian hours. All right. So that's a good thing and a bad thing. For those of you who are very intraday traders or very active traders, then maybe you want to trade it during the US market hours. You're going to stay up at night. Then you might want to just trade the US, instruments instead. But if you're not an intraday trader, active trader, you're going to hold this for a few days, a few weeks, a position trader, and you want that 5 times or 7 times leverage, especially on the short direction, you can consider this. They are listed and traded on SGX in Singapore dollars. All right. So this one you can only trade during SGX market hours, 9 a.m. to 5 p.m., where we'll market make and we will provide liquidity prices. We'll track the E-mini futures during Asian hours. Then overnight, it will trade the cash market index as US market moves at night. This DLC will continue to track it, and then in the morning, it will open up at 9 a.m. with the prices reflecting the previous night performance. Okay, so this one you have that 7 times leverage and that 5 times leverage, and you have the long short direction. So we've seen in the past couple of weeks people buying more and more of the 7 times short NASDAQ DLCs. So this is something that could be more interesting for those of you who are a bit more aggressive and a bit more attuned to the US market. Okay, so this one is our latest expansion on the shelf. Please feel free to raise any questions. For those of you who are tuning in from home as well, please do feel free to put your questions into the chat, into the webinar chat room. We'll be happy to answer them later. Okay, next slide. So Hang Seng Tech DLCs is our best performer last year, and so far in this year as well, it has been most actively traded DLCs. All right, so 7 times leverage on Hang Seng Tech is not for the faint-hearted. All right, Hang Seng Tech is a tech sector index. It moves 3 to 4% a day, possibly. So not like your STI that only moves like maybe less than 1% a day. So 3%, 4% a day, times by 7 times, that is 20 to 30% within a day. All right, so not for the faint-hearted, but we have seen people, use this DLCs to make that kind of gains during the market hours, especially intraday trading. All right, so Hang Seng Tech, sorry, just back a bit. Hang Seng Tech, so we've seen, the market in April is hot right now. Okay, Hong Kong market is pretty hot after so long of a bear market. Finally, we have seen the Hang Seng Index, Hang Seng Tech Index, go into bull market territory. In the month of April, all right, yes, both on average, all the 3 Hong Kong indices, Hang Seng Index, Hang Seng China Enterprises, Hang Seng Tech Index, averaged about 7% gain in April. All right, and from the lows that we've seen this year, it has gained more than 20% to close at the end of April, just a few days ago, more than that 20% gain from the lows this year. So that technical definition of a bull market. Okay, of course, I don't want to, fingers crossed, I don't want to call it too soon. I don't know how long it will last, or I don't know what's going to come. Anything that it can change very fast on the Hong Kong market side. So be careful. And that's why this kind of instruments allows you to be more agile to trade the kind of short-term movements on the Hong Kong market. I wouldn't say go all bull market now in Hong Kong. Watch and see, let it stabilize. But it has closed above the 18,000 key level over the last 2 days, last 2 trading days. So we are really hopeful that it's starting to stabilize. And according to some of the KOLs that I speak to, this is just the start. All right, doesn't mean that Hong Kong will go into a full bull market, run up like a Nasdaq like that for the next few months, but at least this is the start of a more stable and a more hopefully tradable market and investable market as compared to what we've seen in the last 2-3 years, where everyone keeps saying China's not investable, China's not investable. This is much more better, more stable. All right, so bull market technical definition has been achieved. 18,000 level captured on the Hang Seng Index. Let's see in the next couple of weeks. Hopefully the whole sell in May doesn't come into play, sell in May and go away. But let's see. And I hope that these instruments will help you to be able to capture some of the short-term movements on the Hong Kong market in the coming weeks, on the coming months. All right, next slide. But before you trade, before you hit the buy button, as with any instrument or any leverage instrument, please understand what you're trading. Okay, this is not buying a share. This is not buying this is not as simple as buying a share. This is the instrument. It's a derivative instrument that tracks the underlying shares. So you need to understand how it works. All right, so that's my job today. In this short next 15 minutes is to give you a good understanding of what the DLCs can do, how it works. But of course, after that, it can't cover everything today. So after that, please, I'll point you to where you can find more resources and as well as how you can reach out to me to understand more of the product before you hit the buy button. All right, so DLCs have that fixed leverage every day. So this DBS, example of here, DBS was up by 2% on day 2 versus day 1. So you gain from $30 to up to $30.60, 2% gain. All right, 2% times by 5, that's 10%. So that's where the 5 times long DBS DLC will gain by 10%. All right, so 5 times leverage, that's where it is. DBS long DLC will gain by 10%, but the 5 times short DBS DLC would decline in value by 10%. So your gains are magnified, but of course, leverage is a double-edged sword. Your losses are also magnified. Okay, if you bought the 5 times short DBS DLC instead, you will be down by 20%. 10%, sorry, by 10%. So that's where when this kind of thing is a short-term trading instrument, but you also have to exercise your trading discipline, your cut loss discipline when it comes to trading this kind of leverage instruments. All right. So vice versa, if DBS was instead down by 2% today, then my DBS short DLC will be up by 10%, while my 5 times long DBS DLC will be down by 10%. All right. So this is both. So if you are bullish on the underlying stock, DBS, you will buy the long DLC so that you can gain from the appreciation in DBS shares. But if you are bearish on DBS stock, then you will buy the 5 times short DBS DLC. So whatever it is, you always initiate a position with a buy trade. Okay, don't go and short sell anything. Okay, this is not a share where you go and short sell, naked short sell, and then you end up in a buying market, and then we have to come and rescue you. Okay, so please do not short sell anything. You always start your position with a buy trade. You buy the long DLC if you're bullish, or you buy the short DLC if you're bearish. Okay, every single underlying stock, we will have a long DLC and a short DLC for you to choose. Okay, next slide. So this is an example of a screenshot of our website. So before you trade any of the DLCs, please do visit our website, dlc.socgen.com. All right, this is to show you that where the 5 times performance is. On this particular day, on 23rd of January this year, just after market open, 9:55 AM, Alibaba was up by 1.45%. And my Alibaba 5 times long DLC, DKPW. So DKPW is the stock code of the DLC. All the DLCs will come with a 4-character stock code. All right. So it was up by 7.65%, around 5 times that of the underlying stocks percentage movement. All right. So you can see the DLC here, the name of the DLC, Alibaba 5 times long. You can see a lot of information from the name itself. So if you go into your points account, you look for DKPW, type in DKPW, you should be able to see this Alibaba 5 times long DLC. Alibaba is the underlying stock or underlying index that you track. So in the front of the name, you'll see what it tracks, what this DLC tracks. Is it a 5 times leverage or is it a 7 times leverage? So indices, we can go up to 7 times leverage. Single stocks, all 5 times. Indices, there's 7 times. So you can choose either 7 times or 5 times for the indices. Then long or short in the name, you can choose a long DLC or a short DLC depending on what your view is of the underlying asset. Do you think in the short term you'll go up or you go down? If you think it go down, then you choose the short. If you think it go up, then you choose the long. All right. Then SG does not stand for Singapore. Okay. SG stands for Society Generale. Okay. We are the issuer of this DLC, and then the expiry date in year, month, date format. All our expiry are all more long dated, in 1 year, 2 year, or 3 years. But the expiry date really does not impact the pricing of the product at all. Okay. For those of you who are familiar with options or warrants, right? There's such thing as time decay. You don't choose a warrant or option that's too close to expiry. These DLCs are not like warrants or options at all. So the expiry date doesn't matter. Even if you buy 1 day before the expiry date, okay, 22 cents, you buy at 22 cents. The next day, if Alibaba goes up by 1%, this DLC will go up by 5%. Okay, then this 22 cents will go up to maybe about 30 cents, for example. Right? Then we will cash settle that 30 cents to you. Okay. It's the same performance every day, 5 times from the listing date all the way to expiry date. And then after that, whatever value of the DLC is, we'll cash settle to you. Okay, it's not like an option or a warrant where if you expire out the money, you get nothing. All right, this DLC, whatever the value is on the valuation date, 1 day before the expiry date, we will just cash settle you after it expires. Okay, so the expiry date doesn't matter. This kind of instruments that we have in Europe actually is all open-ended. There's no expiry date one. Your TQQQ or SQQQ in the US also is open-ended. There's no expiry date. But certain regulations in Singapore, we have to have an expiry date for this, capped at 3 years. So DLCs are usually about 1 year, 2 years, or 3 years maturity. Okay, next slide. This is the other side of the coin. If you have bought Alibaba short DLC DFTW on this day, this Alibaba short DLC, if on this day and Alibaba was up by 1.45%, naturally you'll be down by 7.7+%, about 5 times that of the underlying assets daily percentage performance. Okay, so gains are magnified, losses are also magnified. I cannot stress this enough. When you're using this instrument, just exercise your discipline. Okay. So that's where it is. All our DLCs are priced between below $2, $1 plus and below to down to 20 cents, 10 cents level. Okay. So the DLCs are priced at a lower price, which gives you that kind of capital efficiency to gain exposure to the underlying stock. Okay, I'll touch on that in the next slide. Yes. So a lot of people use our DLCs to trade Hong Kong stocks. Why? All right. So the DLCs, if any of you have traded Hong Kong stocks before, or you've been trading Hong Kong stocks, it's not that cheap to trade Hong Kong stocks. It's quite expensive. All right. Either you have a big investment sum needed. For example, if I want to buy BYD stock itself, for example, back in 31st December, to buy one lot of BYD on the Hong Kong exchange, I need $18,000 Sing upfront just to get exposure to BYD. I know all of you here, apparently, Vic told me all of you here are all high net worth, very active one, But even then, if you have $18,000 to buy BYD, you might not want to put it all at one go. Right? You might want to scale in your position. Maybe I buy 3,000 today, I buy another 3,000 tomorrow, kind of thing. All right? But if you buy the stock itself, you have to buy one time 18,000. Okay, especially if you are doing a short-term trade, you might not want to put that kind of big amount as well. All right, so the DLCs you can buy for as little as 100 units. Same as Singapore stocks, bought lot units of 100 units. 100 units stands by 20 cents, that's $20. But of course, you don't go and buy $20 of DLC only. Your brokerage really charge you $20 kind of thing. So, but you can go in smaller bite-sized amounts in units of 100. You can buy 1,000, you can buy $2,000, just to get exposure to BYD. So you can have a more capital efficiency. I put in $2,000. I buy $2,000 worth of BYD DLC. My exposure 5 times is 10,000. All right. So I only put in $2,000. So my capital is $2,000 only. That gives you that kind of capital efficiency rather than having to go and buy $10,000 worth of BYD stock. All right. And with a lower capital, $2,000 only to get exposure of 10,000 to BYD because of the 5 times leverage on the DLC. My commissions, my transactions are all charged on that $2,000 only. And we are charged Singapore rate. Okay, not charged Hong Kong rate because these DLCs are listed on SGX. Right, so you're only paying Singapore rates, and the exchange fees for the DLC is 8 times cheaper than the normal stocks. You buy DBS shares, etc., is 0.04%, right? Exchange fees. This DLC on the exchange, because they see it as a trading product, as a short-term trading instrument, they only charge 0.005%. Okay, so it's 8 times cheaper on the DLCs as compared to buying your Singapore stocks. All right, and much cheaper than actually the exchange fees on Hong Kong side. That's why this instrument has been primarily, I would say, majority 60-70% of DLC traders use it to trade Hong Kong stocks, Hong Kong indices. Okay, And also the fact that it's traded in SGD gives them that kind of convenience. They don't have to keep, changing money to Hong Kong dollar, back to Singapore dollar, Hong Kong dollar, Singapore dollar. Especially if you have a lot of US dollars already, Hong Kong dollar is pegged to the US dollar, you don't have so much FX risk. So this is one very good, one very strong value proposition that we've seen on the DLCs, and why it has taken off over the years is people looking to use the DLCs to trade Hong Kong stocks. Okay, so this one, especially if you're an active trader, in and out over a few days or a few weeks, you use less capital, you have less transaction costs, that saves a lot, especially if you're looking for you're an active trader. But if you are buy and hold, you want to hold BYD stock, you want to buy it and hold till 10 years later or like 5 years later, then please go and buy the stock yourself. Okay, don't buy the DLC. This is a short-term trading instrument. Okay. So that's about it for the Hong Kong underlyings. This is one of our key value proposition. On the Singapore side, the 5x short DLCs have been a very key proposition, which I'll touch on later. I know everyone here probably owns like DBS shares or UOB shares that you're holding for a dividend yield for long term. But in the short term, there are movements on the market, right? DBS, if you think that DBS has rallied so much in the last couple of days, which it has, you think it's time for a correction, and you are, but you don't want to sell your DBS shares, you want to hold it for the dividend yield, but you feel a bit pain if you see your share value come down, then you could possibly use the 5x short DBS DLC to make some gains if DBS stock indeed corrects, and to offset your paper losses on your overall investment portfolio. So next slide. People use it for day trading. So Hong Kong stocks, wow, it's pretty wild. Okay, you can move like 4, 5, 7, 8% in a day. All right, so intraday trading definitely is very common on our Hong Kong stock DLCs. People buy in the morning, sell in the afternoon for that double-digit gains. All right, for Singapore stocks, maybe not so much. It doesn't move more than like 1% a day. All right, so even 5x leverage, maybe like 5% a day. So what we see is that for Singapore stocks, people tend to use a more swing trading or position trading kind of angle. And for Singapore stocks, holding it over a few days or a few weeks, that's fine on the DLCs, but please do not hold it for months at end. Okay, and lastly, hedging, which I just mentioned. You can use the short DLCs to hedge your overall investment portfolio. Let's look at some examples over here now. So on day trading, if you have bought the 7x long Hang Seng Tech DLC, this one ILKW, the stock code is ILKW, you bought it at 50 cents in the morning at 9:30 a.m. from market maker, from us. Then you sell it at 60 cents. The bid and ask prices will go up during the day because Hang Seng Index gained 3% from 9:15 a.m. to 1:45 p.m. So our bid and ask prices will move up from 50 cents to about 61 cents. If you sell it at 61 cents back to us, you will make an intraday gain of 21% just for that few hours. Okay, so this is one of the reasons why people use the DLCs for intraday trading. For a 3% gain on the index, you buy the ETF, you gain 3%, you're like, the amount of cost that I pay on commission and transaction, it doesn't make sense for me. But if I use a leverage instrument like the DLCs for intraday trade like this, index move 3%, I can gain up to 21%. Then I can make that intraday trade. All right, so intraday trading is very common. Next slide. Swing trading. Okay, if I'm looking at Singapore stocks instead, and they don't move that much intraday. So Sembcorp gained 7% during this 14 trading day period between 26 December to 15 Jan. All right. So again, if I bought at 55 cents on the 26th of December, and then our bid and ask prices will move along the days. All right. So the Sembcorp long DLC rose from 55 cents to 75 cents at the end of that 14-day trading day period, representing a 36% gain over that 14-day trading period. So 7% over 14-day trading period is like okay, but not like nothing great, right? So you have that DLCs that can amplify your returns over that 14-day trading period with the DLCs. So if you bought the 5x long Sembcorp DLC, DWIW, you have gained 36% during the same period. All right. So again, losses, your gains are magnified. 7%, you get 36% on the DLC, but losses are also similarly magnified. Okay, next slide. Hedging wise, as I mentioned just now, you're holding DBS shares for the dividend yield, that lucrative 6% dividend yield. You're not going to sell it, even if DBS shares are hitting all-time high now, and you think that's going to correct from here. But you're not going to sell because I'm holding on for the dividend yield. Fine, then you can use the 5x short DBS DLC. And this example over here, DBS fell by 4% over this 16-day trading period between 14 November to 5th December last year. My 5 times short DBS DLC DEOW gained from 73 cents to 88 cents during this 16-day trading day period, representing about a 20% gain for this to offset your overall investment losses on your paper losses on your long-term investment portfolio. Okay, so this one is increasingly more getting more popular with our DLC traders. Of course, DLC traders somehow everyone are a bit more long bias. All right, so stock go up, people buy long DLC. Stock go down, people buy long DLC also. Okay, shorting is not for everyone. Shorting is a bit more sophisticated to trade both sides of the market. You require a bit of a pretty sharp mentality, agile and disciplined mentality to trade both sides of the market. You go to speak to any guru out there, they will tell you, yeah, shorting is a different ball game altogether. Your mindset is different. All right, but people are starting to get used to this to trade both sides of the market. Given that also, our Singapore market, it's range bound lah. I think it's still over the bit of a longer time frame is still range bound. It will not be like the Nasdaq where it goes to all-time high kind of thing. Singapore market will continue to be range bound, and within that wide range, there are a lot of trading opportunities, and that's why we thank Phillip as well and everything, because Singapore market needs a bit of injection of some vibrancy and some excitement, and that's why we have also feedback from the ground that this kind of instruments adds a bit of that excitement to the Singapore market, which is just pretty quiet, okay, or pretty boring in the short term. Okay, so this is the hedging example on the 5 times short DBS DLC. So whenever you go short on any and you go short on any stock, etc., always use an instrument. Okay, always use an instrument that will help you. Please do not go and naked short the underlying stock, because that one is really dangerous. Okay, so if you're going short, always try to use an instrument. For this instrument DLCs, another value proposition is that if I buy $2,000 worth of DBS short DLC, the most I can lose is $2,000. Okay, even if underlying stock DBS Piyush Gupta resigns, okay, DBS tanks minus 30%, touch wood, okay. 30% times by 5 times short is 150%. But I will not lose 150%. Okay, I put in $2,000, I will lose 100% max. Okay, that 100%. But I will not be asked to pay up that 50%, etc. That one is for us to take on the risk as the issuer. Even if the underlying drops adversely against you, your maximum loss is kept at whatever that you put in. For some of if you naked short the underlying stock, then that's very scary. All right, that one naked short, you have to pay up that 150% no matter what. Okay, so that one is, that's why I say when you go short an instrument, please do not naked short. Look for an instrument if you want to go short, and this DLC is something that you can consider because your losses are kept at that 200%. Okay, you will not lose more than you invested. Okay, next. So when you trade any DLC or any fixed leverage instrument out there, it's very important for you to understand this key feature. I'll go through this, and then after I'll go into my website already. So the last point here I want to make is on this compounding effect feature of any fixed leverage instrument out there. Your TQQQ, SQQQ, leverage and inverse ETFs all have this compounding effect feature. Okay, your 5 times performance, your 7 times performance is on a close-to-close basis of the underlying stock daily percentage performance. Okay, so intraday you get that 5 times or that 7 times, but if you hold it for more than a day, for a few days or a few weeks, then you have to take into account the compounding effect. Okay, compounding effect can work for you or against you. It can work for you in a nice trending market. All right, in a nice trending market, you get the compounded gains, but in a volatile or sideways market, you will get less than that 5 times performance. Okay, so the table on the left here is a positive example of a compounding effect in a trending market. On day 1, underlying stock gains by 1%. Day 2, underlying stock gains by another 2%, and day 3, underlying stock gains by another 2%. Every day, my DLC will give you that same 5 times performance. So 1%, 5%, 2%, 10% on the DLC. Third day, 2% underlying, 10% on the DLC. Overall, cumulative over the 3 days, my underlying is up by 5%. All right. My DLC is up by 27%. So 5% times by 5 is 25%. So where did the extra 2% come from, right? That's because of the compounded gains. Every day, your gains and losses are locked in. So my 10% gain on day 2 is based off a higher base of $2.63. My third day, 10% gain is based off a higher base of $2.89. So that's the compounded gains. Okay, so in a nice trading market, you'll get more than that 5 times performance. I've seen the DLC go from $1 to $10. Of course, that's due to the compounded gains. And please don't, I take back that. That one, he held it on for 6 months. Okay, don't hold a DLC for 6 months, please. Okay, but that's one of the success cases. Rare, and please don't try to emulate it. because to hold the DLC for 6 months, he was really lucky. SIA was in a nice uptrend the whole of the last year. I think last year, beginning of last year. After the post-COVID, it went up. SIA, he rode from $1 to a $10 SIA, his SIA DLC, 5 times long DLC. And that's one of the best I've seen. I mean, he got balls to really hold for that 6 months. And it was a nice trending stock like SIA. Okay, but I can't say the same for a lot of other majority of the other stocks. All right, your Hong Kong stocks, etc., is just whipsaw. Okay, everything. But if you can manage to capture a nice trend, you will get more than that 5 times performance. Okay, again, I stress, please do not hold a DLC for 6 months. Okay, short-term trading instrument, a few days or a few weeks. But that compounded gains is important for you to understand. Okay, so it can work for you or against you. So that's one of the reasons why this product is not meant to be held for a long period of time. In a long period of time, markets are really sideways. Okay, markets will always mean revert. So the compounded gains will not work for you if you hold it for a long period of time. But over a few days or a few weeks, you have kind of conviction of the trend. Then this DLC could work very well for you. Okay. Compounded effect. Okay, so it's basically like your compounded interest, right? So compounding effect is it works for you or against you in a nice trading, works for you in a nice trading market, but it doesn't work for you in a sideways moving market. So in the table on the left here, the underlying starts off at 100, right? It gains 1% in day one. And my DLC will give you that 5 times performance because the 5 times leverage is based on a close to close basis. I'll give you that 5%. So DLC will gain by 5% on day one, because the underlying is up by 1%. On day 2, it's up by 10% because the underlying is up by 2%. And on day 3, it's up by 10% again because the underlying is up by 2%. So every day you get that 5 times performance on a close to close basis. But cumulatively, all right, cumulatively, you have to take into account the compounding effect. Okay, so over the 3 days, my underlying is up by 5%. But my DLC cumulative is up by 27%. If I take $3.18 divided by 250, that is a 27% gain. More than that 5 times performance. Okay, that's because your gains are compounded. Every day, my 10% is based off a higher base, and my gains on the third day is up by off a higher base. So that's why your gains are compounded. Okay, but with compounding effect, it doesn't work so well for you if there is a volatile market, where a sharp drop on the day 2 on the table on the right over here, a drop of 4%. So my DLC lost 20%. But even if the underlying rebounded the next day, my DLC up by 37%, but it's still less than a 5 times performance because the 37% gain on the third day is based off a lower base of $2.20. Okay, so there is less than a 5 times performance. So this is one of the key reasons why you should not be held for long term. Yes, it works for you in a downtrend. Okay, so if you're buying the short DLC and it's a downtrend, you make exceptional gains, okay? You make more than 5 times. But if you're holding the 5 times long DLC and then persistent downtrend going against your direction of your DLC, the compounding effect works for you because it lowers your exposure. Okay, you lowers your exposure. So you will see that you actually lose less than 5 times performance over that downtrend because your 5 times loss is based off a lower base as well. So your exposure is lesser, and that's why you lose less than that 5 times performance if the direction goes against you. And that's another very, very not many people pick that up. Everyone only see like what happens if I make that kind of gains. But what happens if it goes against me? How does the instrument help me? And that's a very good observation. Yes, sorry. Yes, actually it's our proposal. We didn't, of course, all these leverage factors is still governed by the SGX and by the MES. So what we propose, we need to seek their clearance. But this one is what we proposed. Because on the Europe side, 7 times we see as a sweet spot for indices. Too high leverage also is not good. So 5 times for stocks and 7 times for indices is what we view as healthy levels of leverage. Of course, if you go and look for other instruments out there, you can go up to 10 times, 20 times. But for us, we think that this is the sweet spot for both from a healthy leverage standpoint, but also where people are more comfortable with. So we are not catering to those high very aggressive traders who want that 20 times, 10 times. But we are trying to cater to the mass retail. This is more of a retail product. Mass retail, I don't think people want to go up to 20 times or 15 times leverage. So that's why we see, our view is that this is a healthy level. Yes. 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 So some of the DLCs, we take a bit more time to refresh. So we did have short DLCs before for some of the perhaps more volatile stocks like Anta, Bilibili. We did have some of that short DLCs before. But given the volatility in the market we've seen over the last 1 year, we have taken a bit more of maybe a more prudent approach to wait and see. To see whether we should issue a more short DLCs. Or sometimes we also see that there is no demand. To be frank, sometimes I mentioned that a lot of people like to long only. If the short DLC has not been traded at all, the short DLC has not been traded at all for the last 1 year, we prefer to just take it off and not refresh the short DLC and keep the long DLC only. But if there is demand, there's nothing stopping us from doing a short DLC. Oh. Yeah. Hong Kong real estate. I mean, okay, China property stocks have suffered crazy. Okay, and I know it's been running up quite a lot in the recent days. But I think yes. But sometimes we also try to moderate a bit. I know. So in terms of like catering to demand is one thing. But we also trying to identify those that are not high risk sectors. So high risk sector, I would say that China property is a bit high risk, still labeled as a high risk sector right now, given all the company finance fundamentals are not doing very well. We also don't want our investors or DLC traders to get caught in a situation where the company liquidates or anything. So for us, it's improving the China property sector. We might do it again one day. But for now, we are taking a wait and see approach to make sure that the sector is on firm footing before we start to introduce more of such stocks. Because I mean, we think that a lot of people have been burned by the property sector already, the China property sector. And we don't want people to, we don't think it's that stable yet for people to trade it or even invest in it. As REITs, we tried before, no one traded. Yeah. Okay. Ken, we can do the questions. After this round, then we'll go into the website. Give me 5 minutes to go through the website. After that, then we can do more Q&A.
First of all, DLC, there's definitely a counterparty that you guys.
Yes, we are the counterparty.
So I know there's so much counterparty. Okay. My final question is that what is the fee for your counterparty like you guys do?
Okay, maybe I start in reverse. Okay, so the fees that we charge, right, are published on our website daily. Okay, we do charge a 0.4% management fee. So nearly scared you all there. 0.4% management fee. Okay, and then we do charge the overnight funding cost. Okay, overnight funding cost. But this one is mostly cost to us. Okay, overnight funding cost. If you hold it overnight, there's an overnight funding cost that you will charge to provide you with that leverage. Okay, but otherwise, how we earn is the management fee, 0.4%, as well as the B&R spread. So B&R spread usually is around 1% for the indices, less than 1% for the indices, and it can be 1 to 2% for the stocks. Okay, we charge based on the spread. I mean, we earn from the spread and a bit of the management fee. Overnight funding cost is more of a cost to us. That one is the same as any leverage instrument out there. Your CFDs or any other leverage instrument, we have to charge that overnight funding cost to provide you that leverage. But the good thing about the overnight funding cost is it's not time decay. So if those of you who trade warrants or DLCs, you know that, or warrants or options, you know that time decay accelerates towards expiry. If you buy a warrant or option that is very close to expiry, every day you hold it, wow, it takes a big chunk of the value of the warrant or your option. But this DLC is an overnight funding cost similar to CFDs. It's fixed every day. Every day, so the say 10% per annum, all right, is the funding cost. You divide by 360 days, we divide the same amount every day, and we publish it on our website every day for you to see. Okay, to your second question, we are the counterparty. All right, Society General, we are the counterparty to this. That's why we are the issuer and the designated market maker. Okay, so you bear the counterparty risk. Okay, but we are a very stable, AAA rated bank. Okay, we are a very stable bank. So I would say that the counterparty risk is you're in safe hands lah. Okay, so on that front. Okay, but there is still that risk because we are the counterparty. If SocGen do go down one day, then yes, you bear that risk. Okay, but we are a very big bank. Okay, we're almost like DBS or bigger. Oh, and the tracking error. There is no tracking error for this. So this is not a leverage and inverse ETF. Because this one is the formula of how it tracks the underlying is inbuilt into the product itself. I am obligated to give you that 5 times every day. I'm not like a portfolio manager at the back like ETF, right, where I have to try and replicate. Yeah, ETF is a portfolio manager trying to track, and it's of course it's a basket of stocks, index, right? So it's not easy for them to track. For this one, it's inbuilt into the formula. You can look at our term sheet, SLT. The formula is there. And that's why people have taken up to DLCs a bit more than, say, your options or your warrants, because I can see that 5 times performance. All right, I can see that. And if there's anything, I'll show you my website later. Give me a call. I will make sure that your answer is addressed so people can actually see. But if you're trading an option or warrant, there's no way they can tell whether is it because of implied volatility or what, why it's not tracking the underlying, so you can't be able to see. But for DLCs, underlying up by 1%, DBS, I have to give you that 5%. If you see only 4%, please give me a call. But that shouldn't happen. Okay? All right. So our website, just to show you guys very fast, you can go to the web browser. Yeah, so just to point out our website, dlc.socgen.com. So the mouse pad that you have and the foldable bag that you have, it's the website link is there. All right, so that one is from us. These goodies, NTUC charges 5 cents per bag now, so I hope the foldable bag will come in useful. All right, mouse pad. I know all of you are clicking the button to buy and sell every day. Your wrist hurts already. So please use the mouse pad. This is our website, dlc.socgen.com. Okay, you can scroll up a bit. You can find more information under our education tab. All the FAQs, the videos as well. You can go to the videos on the left. Yeah, videos. If you can only watch one video before you start trading a DLC, please watch this video. How to select the right DLC for your target exposure. Okay, this one is important for you to be able to select the right DLC for target exposure. And then you can find the full product list of DLCs on the products page under search. Okay. So over here, please do check out our website, dlc.socgen.com at home. And last thing, the most important is the number at the top there, 6226-2828 on the right-hand corner. Anything at all, you want a refresher of what I just said, you want to give me feedback, you think that there's tracking error, give me a call. Any questions at all, please give us a call. My team and I are on standby during market hours, 9 AM to 5 PM to answer any questions you have about the DLCs. Okay, the market is hot now for Hong Kong. So I hope that you will find this useful in terms of for your trading journey. Okay, we'll answer maybe.
Okay, yeah. So thanks, Marcus, for the sharing. All right. So, because we are also overrun a bit of time, so we'll take some questions from the online instead. Well, maybe. Okay. So, right now, one of the questions I think that the online one have is that why is the US bank having a different price performance than Singapore banks? They are also facing the higher Fed rate. So maybe Paul want to take.
Actually, I don't know how the US banks are performing. I also don't cover the US banks. Glenn is the one is covering. So I'm not very sure why. But I saw the performance. I think they did really well this year, which I'm surprising because most of their loans are all fixed rate loans. So I don't really have a good answer. Their yields only 2%, so I'm not sure why. But Singapore market underperform US always so anyway. So I don't have any clear-cut answer, sorry. Yeah, I don't really cover it.
So I think also we'll just take one more question. Main one, I think the DLC, sorry, the DLC one, I think he mentioned some questions to the audience just now already. So I'll just mainly cover on whether or not there's this one about you say the glory days of the China Tech Act by Alibaba, Tencent are over. Right. So basically right now I would say that the glory day of like the 20%, 30% per data of return with so-called, obviously it's over, but you wouldn't really see happening. So two things, one is because of the size that they are already at. You can't really see that level of return for these companies, even though of course like Google and Microsoft did show 10% returns on their results day itself. But for on the ongoing basis wise, the tech giants shouldn't be that strong. But as a whole, Hong Kong tech industry is still very undervalued, even at the current revaluation and recovery that we see in April. So right now it's still quite good per se. Okay, so before we move to the next part, right, just take note first is that do remain seated, not to worry. We will actually be bringing the food to you. So don't have to go there and then queue, right? So they'll be bringing the food over to you when we end the session. Okay. Okay, so thanks everyone for joining us for this event. All right. We hope that it's interesting to you. So for questions that we might not be able to answer to you just now for the Q&A, you can also see if we reach any of our staff to let us know if you want us to answer you through email or whichever. And for the question on Zoom, also we will also can answer you later on, right? If you email us the question itself. All right. Okay. Sorry. Yeah. Okay, so as long as it is Singapore listed, you can trade on SRS. If I'm not wrong. I remember it's can. CPF cannot, for sure. SRS can. But do note that even though it is can, the risk is still there. So another reason to answer the question this gentleman have of why not too high, right, is that you don't want later a point where the underlying overnight move 10%. Then you 10 times means the whole thing just disappear. So that's why he mentioned that Marcus mentioned that it's a more suitable leverage ratio, 5 to 7%, within the most of the retail level risk appetite. Yeah. So you can still trade. There's a leverage involved. SRS can be used, but SRS mainly for retirement basis, right? So I wouldn't recommend a super high risk investment through SRS. Yeah. Yeah.